The 5% deposit scheme. Wherever which part of Australia you're in is probably the one scheme that most first home buyers can take advantage of. People may say you need 20% deposit to buy your first home, but with how quickly properties are growing, 5% is the new 20%. Hi everyone, my name is Victor. I'm a mortgage broker that will tell you everything I know about finance. In this video, I'll go through the 5% deposit scheme, who qualifies for the scheme, how to apply, and common questions I get from clients. Let's get started. What actually is the 5% deposit scheme? As the name implies, it allows you to buy your first home with a minimum of 5% deposit without paying a fee called Lender's Mortgage Insurance, LMI. Usually, you need a 20% deposit to avoid LMI, which is basically a massive insurance fee you pay to protect the bank in case you can't pay your loan. It doesn't protect you at all, and it can cost you up to 5 digits. Now, there are only 3 ways to skip LMI. You're a medical professional, lawyer, or other high-end professionals. Your parents put their own house on the line as a guarantor, and the 5% deposit scheme. Think of this scheme as the government stepping in to replace your parents. They tell the bank, if Victor defaults on this loan, we'll cover that 15% gap. Because the government is the guarantor, the bank waives the LMI fee and gives you a lower interest rate as if you had the full 20% deposit. If we look at the 5% deposit scheme and compare it to a standard 5% deposit loan, the benefit of the scheme comes down to no LMI premium, a lower interest rate, greater borrowing power, and less deposit required. So, who can actually access this? There are a few boxes you need to tick. As of right now, here are the requirements. You must be an Australian citizen or permanent resident and at least 18 years old. If you're a Kiwi, the special category Visa 444, which normally is granted when you land, is also acceptable. You need a minimum of 5% deposit saved. If you're a single parent or guardian, you only need 2%. The bank would generally want this to be genuine savings, which is money you save yourself, but there can be exceptions. This is for first home buyers or anyone who hasn't owned a property or land in the last 10 years. So if you own and sell your home 15 years ago and haven't since, you're back in. You have to live in the home. This isn't for investors or rentfestors. Your loan must be principal and interest with a term of up to 30 years. You can apply on your own or with one other person. That can be a partner, a friend, or a family member. There's no income caps or spots limits each year, so as long as you're buying a property within the price cap, you'll be fine. The government doesn't let you just buy any house with the scheme. It has to be under a certain price cap based on where you're buying. Price cap varies from state to state. These caps are designed to keep the scheme for entry-level homes, but Housing Australia update these price caps from time to time to keep up with the market. If you're unsure of what the price cap would be for the specific suburb you're looking for, here's the tip. Go to the postcode checker on Housing Australia's website, type in your postcode, and you will know instantly what the limit is for the area. If you're building, the price cap has to cover the total cost of your land plus your building contract. If your total ends up at $1 million and 1 cent in a $1 million zone, the scheme is off the table and you're back to paying LMI. You can apply directly through a participating lender. The full list of 30 banks is on the Housing Australia's website, or you can go through a mortgage broker like me. The benefit of using a broker is that I can scan all these participating lenders at once to find the one that fits your specific circumstances. The process is pretty straightforward. We apply for the scheme as part of your home loan pre-approval. Once you're pre-approved, the bank helps you lock in your spot for 90 days. This 90 days is when you go out and find your property. And because the spots are now unlimited, you don't need to worry about losing your place if you don't find a property within those first 3 months. We can simply refresh the application and keep going. One most common risk with the scheme is valuation risk. Say if you buy a house for $800,000, but a bank valuer says it's only worth $780,000. You still have to pay 5% of $800,000 to the seller, but the bank would only lend you 95% based on that lower number. You would have to bridge that $20,000 gap out of your pocket on top of your 5% deposit, or switch to another lender that gives you a better valuation. This valuation shortfall often happens when you buy a brand new property where you pay a premium, similar to you buying a new car. Doing your research thoroughly can effectively mitigate this valuation risk. Unfortunately, no, the participating lenders want you to use up majority of your savings when it comes to the purchase. Normally they will let you keep around $13,000 to $15,000 for a purchase, and a bit more if you're doing construction. Usually a 5% deposit means a higher interest rate, but with this scheme the answer is no, because the government is guaranteeing the 15% gap, so the lenders would treat like you have a 20% deposit. So you get access to their most competitive discounted rates, which can save you hundreds of dollars each month compared to a standard 95% loan. I hear this all the time. The answer is a hard no. This isn't a share equity scheme. The government doesn't own a single brick of your house and they don't take any of your profit when you sell. It's simply acting as a guarantor for the bank so you don't have to pay for LMI. This is a yes and no. You still have to pass the borrowing power test with the lender. If you want an $800,000 house, you're borrowing $760,000. If your income only supports a $700,000 loan, you actually need a $100,000 deposit. The 5% is the minimum entry fee, but your income decides the maximum you can actually buy. Additionally, you still need to budget for solicitor fees, building inspection fees, etc. And depending on the purchase price, you might still need a bit of money to pay for the stamp duty as well. I want to leave you with a final thought on where the market is right now. For a long time, the gold standard is always the 20% deposit, but let's be real, the $600,000 property you are looking for will be $700,000 by the time you save the money. In my view, 5% is the new 20%. The race has changed. It's no longer about who can save the most over 10 years. It's about who can get their foot in the door first. Is the system perfect? Absolutely no. But we have no choice but to play the game, and playing the game means using the tools available, like this scheme, to stop chasing a moving target and start building your own equity. People ask me, Victor, isn't a 5% deposit dangerous? Honestly, not necessarily. The real danger isn't the size of your deposit, it's your income. The most dangerous moment for any homeowners is if they lose their job and the income drops to zero. If you can't pay, it doesn't really matter if your deposit was 5% or 20%. That's why my advice is, buy what you can within your comfort zone and start there. Don't just buy for the sake of buying. If you overstretch or buy something you absolutely hate and are forced to sell, the only people laughing in the end are the government and the agents. My goal is to help you make the right financial choices so you get into a home you can actually keep. If you want to, hit the link in the description to book a 15-minute first home buyer call. I'm Victor, and I'll see you in the next video.